For that discussion, we're joined by Nicky Weimer, Group Chief Economist for Nedbank. Nicky, you are our market watcher today. So I want to begin with the South African rand. That very strong move that we saw from the currency, it started yesterday, strengthened today. What do you allude to? Is that simply the direction and the dots that have been painted by the US Fed?
I think that the global forces are going to make the rand quite choppy going forward. So I think that's one thing we have to anticipate. The US Fed certainly indicating, that they really reaffirmed the message that they had been provided at the previous meeting, and that is that they foresee that they will start to taper relatively soon, before the end of this year. And basically indicated, if you look at the interest rate forecast, that's closer to 2023, around that space. So they didn't really change their message. So it is surprising the way the markets have been gyrating all over the place in response to that. But I think that that's to be expected. As we see monetary policy normalize, investors will be adjusting their portfolio, risk sentiment will change, and that will have an impact on the rand. And I think while you had a tremendous, you had a spell of weakness in the currency, a very rapid depreciation that came through over the past 2 weeks or so, that might have been overdone. And in South Africa, we still have a very steady monetary policy situation. Our inflation is not nearly as high as it is elsewhere. And, just that sort of stable picture for a change from our side, perhaps supporting the currency as well. But I think it's more a case that the movement in the rand has been overdone up until recently.
Yeah, this discussion, Nicky, reminds me of that saying, I think it's by you economists, or is it the investment people, who say the market is always right. And I say that saying now because I remember the noise that was, I think, about a couple of months ago, where people were saying, no, the central bank, especially the Fed, is getting the trajectory for interest rates wrong. They need to be indicating that they are coming into the market. And the Fed said, no, hang on, you people. We think this is going to pass. The Fed turning out to be right to a degree. Let's come back home. So you were listening, the governor coming through, I think in line with your own expectation at the Nedbank Group, but also in line with the rest of the market. Was there anything in that statement that warranted you sitting and listening to Governor Kganyago today?
No, I think that it was broadly almost exactly unchanged from the last meeting. There was changes to the GDP forecast. If I had to identify something that sort of concerns us a little bit, is the downward revisions to the GDP forecast for 2022, which is next year and the year thereafter. Initially, they had growth. At the last meeting, they suggested the economy would be growing at a pace of over 2% over the next 2 years, where they've now revised it to below 2%. A lot of that might have to do with the fact that we've had these big revisions to GDP estimates coming through from Stats SA. And off that higher base, the upward revision to this year's growth numbers results in slower growth from that normalized base. But nonetheless, it's a bit worrying. And I think the fact that they certainly believe that the riots and the pandemic will inflict some long-term scarring on the South African economy, and particularly on certain sectors, that is the bit that concerned me.
Yeah. What about the inflation focus? Was that in line with what you're expecting?
Yeah, very much so. In fact, they revised their forecast up to more or less what we have been anticipating for quite a while, and that is that inflation will average around 4.4% this year. And then we deviate a bit from them in terms of our expectation for next year. They see inflation moderating again next year to 4.2%. And then picking up and averaging 4.5% in 2023. And within that context, of course, with inflation moving towards the midpoint of the target range, their quarterly projection model still suggests that there is, or it still points to a 25 basis point hike in the final quarter of this year and 100 basis points both in 2022 and in 2023.
Yeah. The other conversation that, of course, I know people like you will be having is that having heard the governor speak now, obviously the other risk factor that's still within this year is the mini budget statement coming through at the beginning of November. But I wanted to know when you expect the normalization process to start. I'll tell you what we got from two economists that we had in the studio earlier today. One was March, the second one was July. Where are you at?
Yeah, I think we're probably leaning more towards March earlier on. I think that, then based on our forecast, you can only try and guess what's going to happen there. But based on our inflation forecast, that's when you'll have inflation at a fairly high level. And obviously that would mean that it's a little bit easier to justify moving interest rates higher. And I think the Reserve Bank's going to struggle with this because you've got a growth picture that is, yes, it's reflecting a recovery. Your output gap is narrowing over the next 3 years, but overall, it's a very uneven recovery. It's uneven among income groups. It's uneven among sectors. You've got exceptionally high unemployment rates.
Yeah.
In that sort of growth environment and that sort of growth picture, combined with what is really a very benign inflation outlook based on the Reserve Bank's forecast, it's going to be difficult to justify normalizing interest rates, even though it is necessary.
Absolutely. So earlier on, I was having a discussion with my colleague here, Fifi Peters, and we were talking about whether the Reserve Bank is likely to move on normalization before the U.S. Fed does, given, as we know, we do still need foreign money to help with the current account deficit and also, of course, their interest in our assets here. So I want to know, from your perspective, what factors will impact that decision to normalize in terms of the weight of those factors?
I think that that's what I was saying. It's kind of a toss-up between January and March. If we do see the Fed start to make an announcement, release their schedule, and we get a sense of how they're going to go about the tapering of bond purchases, and that results in financial ruptions. In other words, the dollar suddenly starts to strengthen, the rand starts to fall. Yeah. You see the global equities, which are looking a little bit lofty at this point, also come under pressure. And there's just generally greater risk of sentiment out there, then the Reserve Bank might be prompted to move in January. So it's all, I think, still very much up in the air, and it's very dependent on what the Fed does, and essentially how the global markets play out over that period.
So would you say it's more like external factors as opposed to, say, domestic factors?
Yes, I think so. I mean, from the domestic side, we've actually had, on the inflation front, a fairly subdued picture compared to other countries. In Latin America, you've got producer inflation well into the double digits. In some countries, over 20%, over 25%. You've got inflation rising very rapidly towards double-digit levels, whereas we haven't had that experience. Our overall inflation story has been very subdued, given that there is persistent upward pressure globally on prices, whether it be food prices, whether it be oil prices that have normalized, and whether it be the cost of certain intermediate goods. And yet we haven't experienced that. And so we are a little bit of an exception as far as that's concerned. So I think the Reserve Bank is well aware of the fact that our inflation story is different. But nonetheless, once the pressure mounts and once the Fed actually starts to normalize, it will result in greater volatility.
Potentially. So while I have you, Nicky, I wanted to ask you about your thoughts on the mini budget that's going to be presented by a new minister, if you like, though we know he's been in the background pulling the strings and saying to the various finance ministers, hey, this is better for the ANC, etc., etc. So your thoughts on what's likely to be in that mini budget statement, and whether this guy is going to be different to the previous guy who I think the markets liked, Tito Mboweni.
Well, I think we're all going to have to get to know the new finance minister in that particular position. I mean, we all have some exposure to his thinking, to his general ideology, to his general approach to economic challenges, and all of that appears to be exceptionally sound. It has to be said. But we'll have to see how he comes across in this specific role as finance minister, which is going to require, I think, a fairly strong and steady hand, because fiscal risks are elevated. But the one thing that will make a difference, I think, come the mini budget, is that we've had these substantial upward revisions in GDP. So it's going to make the deficit look better, and it's going to make your debt numbers look better. So I think the fact that we've seen GDP revised upwards between 9 and basically 11% between 2011 and 2020, and we've had stronger than expected GDP outcomes in the first half of the year, is going to make all of those fiscal metrics look a little bit better.